Hello, guys. Welcome back to the second episode of the full Smart Money Concepts course. In the previous episode, we have understood about the market structure mapping in great detail. In this video, I would like to introduce you to a completely new topic. It is known in different names in SMC, be it fair value gaps, imbalance, inefficiency, etc. But the overall concept remains the same. What you need to keep in mind is that such imbalances in the market happens due to irregular or disproportionate price movements. These price movements may deviate from what is considered normal or expected based on historical price patterns, fundamental analysis, or technical indicators. Such inefficiencies or imbalances can create potential trading opportunities for both investors and traders. But imbalances in price behavior can take different forms. Just think about it. Could be in the form of gaps, volume imbalances, spikes, lack of liquidity, displacement, etc. Now, I will try to explain each one very briefly to get a general idea of what is what. Let's start with gaps. Price gaps occur when the opening price of a candle is significantly different from the previous candle's closing price. So, a gap has a complete absence of trading activity between two candles. Now, these gaps can be caused by various factors, such as overnight news, earnings reports, or other market moving events. And gaps can be of different types. It can be breakaway gaps, runaway gaps, exhaustion gaps, and professional gaps. Depending on the type of gap, you can choose to adopt a particular strategy to capitalize on the imbalance. I have already made a detailed video on gaps and how to trade them in my complete price action course. You can check that out to learn more. Next up is volume imbalances. A volume imbalance is a gap between the closing and opening price of two candles and the difference in between. A volume imbalance, in fact, has a trading activity happening, or there is an overlap between the high and low prices when compared to a price gap. Now, a quick example of a volume imbalance would be from this closing price to this opening price. And also we have a gap. However, the price did manage to trade through these areas. So it is indeed a volume imbalance and not really a price gap. Moving on, price spikes refer to sudden and sharp movements in a security's price, often resulting from an unexpected event or a large surge in trading volume. Now, these spikes can be caused by different factors such as market orders, stop loss triggers, or algorithm trading activity. Now, in some cases, low trading volume and liquidity in a particular stock can lead to inefficiencies, as it may result in a wider bid-ask spread and difficulty in executing trades at desired prices. So traders need to be cautious when dealing with illiquid stocks, as it can be challenging to enter and exit their positions without causing significant price impacts. Now, all these are in some form or the other a type of imbalance in the market. But when it comes to smart money concepts, we are only concerned about the imbalances caused due to displacements. So, displacement, in short, is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single candlestick or a group of candles that are all positioned in the same direction. Now, these candles typically have large real bodies with very short wicks, which suggests that there is a very little disagreement between buyers and sellers. Or in other words, only one party has a clear dominance over the other. Most often, a displacement will occur just after a liquidity level has been breached, where there are clusters of orders, and this will often result in the creation of both a fair value gap and a market structure shift. Now, we have already discussed market structure mapping and terms like BOSS, chalk, etc. in the first episode. So make sure you have a proper knowledge of the same. But right now, what we are concerned about are fair value gaps or inefficiencies or simply imbalances. So after the price reaches a particular liquidity level where large numbers of orders are accumulated, and when price reverses after absorbing the liquidity from this area, often what will come next is displacement. So these fair value gaps are usually created within these displacement moves, which means that these are instances in which we can spot inefficiencies or imbalances in the market. I have talked about liquidity levels where most of the orders are accumulated. But how to identify these levels? There is a simple rule to spot these areas. So, the last bearish candle or selling momentum before an up move is referred to as a bullish order block, where a large number of buy orders are assumed to be located. Similarly, the last bullish candle or the last buying momentum before a down move is referred to as a bearish order block, where a large number of sell orders are assumed to be clustered. Just keep this in mind and don't stress a lot because we will learn all this in great detail in the upcoming episodes. Now you can ask me, why is an imbalance or fair value gap for that matter considered as an inefficiency? The reason is simple and straightforward. When price moves strongly in one direction, and that too by means of large-bodied candles, there is a clear discrimination between the buyers and sellers. Let me explain. Imbalance, as the name suggests, is an area of unequal market moves where there are only buyers or only sellers which exist in the market. The reason we call this an imbalance is not only because it is an imbalance between buyers and sellers, because there is literally an imbalance in the market. Trading volume is tilted either towards the bid or ask side too quickly, so there are still a lot of unexecuted orders in the market. So if we have an impulsive move to the upside, it is because there are no sellers to absorb the buying pressure of the bulls. This means that there is no resistance from sellers to stop the buyers from pushing the price up rapidly. On the other hand, if we have an impulsive move to the downside, it means there are no buyers to absorb the selling pressure of the bears. This means that there is no resistance from buyers to stop the sellers from pushing the price down rapidly. Simply put, imbalances occurs when there are many orders of the same type, be it buy, sell or limit orders, and also a lack of liquidity or counter orders in the market. For example, if there are many more buyers of a stock than sellers, then the balance can tilt in the favor of buyers. And on the chart, this imbalance looked like a price gap within which only a part of the volume has been traded. This is an unhealthy price action because it shows the disequilibrium between buyers and sellers. So an imbalance means unfair price action where the market will almost always come back to fill. Another thing to note is that the wicks do not fill each other. And if they do, then it is healthy price action or efficient price action and not really an imbalance. So to put it simply, market inefficiency occurs when the wicks are separated by a distance or a gap and they do not meet. While an efficient market, on the other hand, is one in which the wicks do not have a gap between them and they actually meet. This brings us to the next important point. How to identify or spot an imbalance or a fair value gap within a particular displacement move. To be absolutely clear, an imbalance can be defined as an imbalance between buyers and sellers. So a bullish imbalance has more buyers behind it, and obviously a bearish imbalance has more sellers behind it. So when you see an impulsive move to the upside or downside in the market with no wicks overlapping full-bodied candles, this is where imbalance in the market are formed. These can happen on all time frames. Now, when looking for an imbalance in the market, simply look for any candle which has a full real body and look for the part of this candle that is not overlapped by the previous and next candle's wick. This signifies an imbalance in the market because there were only a few transactions going on between buyers and sellers. We can clearly say that one party has overpowered the other depending on the direction of the price. Now, if you think about it, wicks usually represent price oscillating up and down within the time it takes to print an entire candle, showing that the price is efficient because there were continuous transactions happening between buyers and sellers. So it shows us that price is giving both buyers and sellers a fair chance at accessing the liquidity. So when the wicks meet, it provides the buyers and sellers an access to get into the market and profit on the price move. But on the contrary, when you see a full-bodied candle with no wicks overlapping it, it is obvious that you have identified a clear imbalance in price. This may seem very complicated and over the roof, so let me break this down further and help you understand it better. Now, a very simple method to keep in mind is to think of a fair value gap as a 3-candlestick pattern where the first candle's low does not overlap with the third candle's high in case of a down move, or where the first candle's high does not overlap with the third candle's low in case of an up move, with the condition that the middle candle has to be a large-bodied candle with little or no wicks. But there can be some exceptions to this rule, which we will look at. But first, let's take a deep dive into this concept. As I have mentioned just now, these imbalances on price chart are visualized by a 3-candlestick sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. Now take a look at this example. The middle candle is a large bearish candle with little or no wicks. Now number the candles as 1, 2 and 3 from left to right. Then consider the first candle's low and mark a horizontal line out, and do the same for the third candle's high and extend out an horizontal line. You can notice that there is a clear gap between the wicks on the first candle and the third candle, and the wicks do not meet or the high does not overlap with the low. Therefore, this can be identified as an imbalance or an inefficient price action or simply a fair value gap. Now consider another example. Here the middle candle is a large bullish candle with little or no wicks. Now number the candles as 1, 2, 3 from left towards right. Then extend a horizontal line from the first candlestick high and do the same from the third candlestick's low. And you can clearly notice that the high and low wicks do not overlap with one another. So we can say this price action is inefficient or not healthy. So this is a fair value gap. Now let's take a look at some of the tricky situations which you could encounter in the charts. On some occasions, you will not be able to apply this rule directly, and you might need to focus on some more important factors before plotting a fair value gap. Observe this over here and tell me, how will you mark the imbalances in this case? So if you look at this diagram, this candle here is our last bullish candle or the last buying momentum before the price drop. So most of you will mark this bearish candle's low, which formed after the last bullish candle, as number 1. And some people might even mark the bullish candle's low as number 1 and then mark the third candle's high. Now in either case, this is not a valid imbalance. And why is it so? If you look at the left side, there is a bearish candle before this up move, and you will notice that the high and low of this bearish candle is protected, meaning that the candle's high and low are not broken by the up move. So if the market creates anything between the high and low of this bearish candle, all those moves are considered as internal moves only. So in such scenarios, first of all, you have to check if the previous candle's highs and lows are broken or not. Then only you have to number the candles as 1, 2 and 3. So here, this bearish candle has to be numbered 1 and this candle's low is to be marked or extended using a horizontal line. The next candle which has broken the bearish candle low is our second candle, and finally, we will also mark the high of the third candle. Now this becomes our valid imbalance, which the market might return to fill or absorb. So keep in mind that internal price moves are not to be considered while marking proper imbalances. Now a lot of people will wait for the price to fill this particular imbalance and they will look for short trading entries. But this is not a valid imbalance. This would have been a valid imbalance if the market would have broken this bearish candle's low. So now the bearish candle is no longer considered. Now when you mark the imbalance, you can consider the bullish candle's low and number it as 1. But the next bearish candle is not taken into account because it is an inside candle which was unable to break the highs and lows of the bullish candle. So our second candle in this case would be this bearish candle which has broken the low of the bullish candle, and then the third candle high is also marked, and the difference will become our imbalance. Now there can be another scenario when the high of the last bullish candle has been broken. Now how will you mark the imbalance in this case? So here this bearish candle is no longer an inside candle, and thus we can number it as 1 and mark its low, and subsequently we can number the other candles as 2 and 3 and mark the high of the third candle, and thereby we can observe the imbalance. I hope you guys have understood all these different scenarios. Now I want you to mark the imbalances for these 3 scenarios on your own. Just pause the video and do it by yourself. The answer will appear on the screen after 5 seconds. So try it right away. So now that you have understood what a fair value gap looks like, let's also make sure what it does not look like. Like before, extend a horizontal line from the first candle's low and another line from the third candle high to see if there is a gap. When dragging the high and low across, you can see that they overlap. This means that the low from the first candle is lower than the high from the third candle. So there is no gap or inefficiency there. And thus, this is not a fair value gap. Similarly, over here, if we were to extend the first candle's high using a line and also extend a line from the third candle's low, you can see that there is an overlap between the first candle's high and the third candle's low, meaning there is no imbalance or fair value gap. So now just to clarify, a gap between the first candle's low and the third candle's high, or the first candle's high or the third candle's low, is what creates a fair value gap. Now, I want you to find such imbalances or fair value gaps on different charts and mark them on your own by this simple method. The next thing we are going to look at are SIBIs and BISIs. These are nothing new. It's just the same concept in a new name and packaging just to induce curiosity. So a SIBI stands for a sell-side imbalance and buy-side inefficiency. What does this mean? It means that the sell side was offered, but the buy side wasn't. So it is inefficient. Or simply put, it represents a bearish fair value gap where the bears have overpowered the bulls. It is also known as undervalued fair value gap. What it means is that the price of the asset is lower than its fair value gap. In this case, the price might increase in the future to balance this inefficiency in price. Now, a BISI stands for buy side imbalance and sell side inefficiency. This means that the buy side was offered, but the sell side wasn't offered. So it is inefficient, or it represents a bullish fair value gap where the bulls have overpowered the bears. It is also known as overvalued fair value gap. What this means is that the price of the asset is higher than its fair value gap. Now, in this case, the price might decrease in the future to balance this inefficiency. So if we look at this price action right here, we have a bearish fair value gap where the sell side is offered, but the buy side is inefficient. So this creates a SIBI. Now, if you look over to the right, you can see that the price has made a bullish fair value gap or a BISI because it offered the buy side, but not the sell side. And that's all about BISI and SIBI. And I hope that clarifies some things for you guys. Now, another relevant question worth asking is, why do market imbalances occur? The emergence of persistent price imbalances in one direction after long periods of stable or efficient pricing indicates that institutions are accumulating positions. Now, these institutions can be funds, banks, and other financial institutions that we call smart money. But do keep in mind that the market is influenced not only by institutions, but also by market makers, investors, and traders with large capital. For example, smart money can place many orders and then modify or cancel them to bring the market back to an equilibrium state. These market makers, traders, and investors can oppose each other, and they can also act in the same direction. In most occasions, imbalances in the market can occur after the release of an economic or geopolitical news. The reasons can vary on whether you're dealing in forex or in other markets. It could be the publication of financial statement. For example, a very positive quarterly report can lead to an imbalance towards buyers. Similarly, it can be corporate announcement of bankruptcy, management changes, takeovers, business purchases, etc. It could also be governmental and regulatory actions, interest rate changes, etc., which could contribute to the imbalance. It could even be political problems, natural disasters, etc. Now, since you have understood what a fair value gap or imbalance is, now you can ask me, how is it useful for traders like you and me? Now, as mentioned earlier, imbalances in the market can be viewed as inefficiency in price behavior, telling us that maybe banks or big financial institutions are involved in the aggressive movements of prices that we are seeing. Again, if you think about it, most impulsive moves and imbalances in the market happen as a result of there being no liquidity in the form of counter orders to stop the price from being met with resistance and thereby slowing down. Now, if you consider an efficient market, we get to see the price trade within a range of fair value for that particular asset, where the sellers will sell when they perceive that the price of the asset is high or the price is trading at a premium, and the buyers will buy when they perceive that the price of the asset is low or is trading at a discount. This is not the case of an inefficient market. The big institutions will create a high momentum move and an imbalance in the market that is much like a gap in price. In most cases, this price manipulation can be a part of institutions' plan to generate liquidity to buy low and sell high, and therefore we may see the price coming back to fill that imbalance or close the price gap before pushing back into the same direction that the price made the impulse move from. And now, to answer the question, how can we as traders benefit from such imbalances? Imbalance is a type of trading opportunity for both intraday and swing traders. In trading, imbalances are used to identify zones of interest. We will talk about these zones of interest, which is more commonly known as order blocks, in the upcoming episodes. The zone from which the imbalance originated is characterized by a higher level of probability. This zone is suitable for analyzing and identifying potential trade entry points. The entry points can be selected with the help of technical analysis within the selector trading methodology. In this case, imbalances act as an additional factor in favor of the trade. So naturally, most imbalances in the market represents an inefficiency in price, and therefore there is usually a good chance that the price will return to fill that imbalance in order to make the price efficient again. Now, I cannot guarantee that the price will always come back to fill the imbalance, but in most scenarios, the price will return to fill the imbalances that form in the market. Because it is a rule of nature that everything wants to come to rest or to be balanced. In the same way, the price also wants to remain in balance. So when an imbalance is created, the price tries to balance it. And the imbalance gap between the wicks of the neighboring candles acts as a price magnet. It means that as the liquidity fills, the price will close the imbalance. This is what we call as mitigation in smart money concepts. Or when we say that the price has mitigated the imbalance, it means the imbalance has been filled and efficient price action has been restored, and the market will most likely continue in the direction of the impulse move. But do keep in mind that mitigation is more a general term, which can be used to indicate a filling of a price gap, filling of an order block, etc. We will talk about this topic in more detail in the upcoming episodes of this course. As you are aware by now, imbalances represent price inefficiency. Therefore, there is a high probability that the market will come back to fill the imbalance. For example, if a large bidder has manipulated the market, a correction might occur afterwards. Typically, price tends to mitigate the imbalance or the area from which it originated. Therefore, we can look to take a trade in the direction of the imbalance in order to profit from the price movement. In this way, we will be able to buy low and sell high like the institutions. However, there are times when the price would just continue to push back against the imbalance that are forming in the market. I won't go deeper into the trading aspects of this concept in this video. We will discuss different SMC trading techniques once we have covered all the basic concepts that guides the SMC theory. Now, I want to talk about some advanced concepts regarding fair value gaps. I won't force you to learn these, but it is worth knowing as it would help you to trade with better conviction and accuracy. Now, there are three things to look out for within a fair value gap. The first being the start of the fair value gap, the second being the consequent encroachment or the 50% of the fair value gap, and lastly, where the price completely fills the fair value gap. We can make use of the Fibonacci tool to mark these levels within these fair value gaps. When the price returns to the fair value gap, we should look for a few different things. This will give us a better idea if the fair value gap is respected by the price or should it be considered invalid. I will be considering a bearish fair value gap or a SIBI for this purpose. So first, the price can either reach up into the fair value gap but close outside the fair value gap and continue lower. Price can also reach up into the consequent encroachment or 50% of this fair value gap. In this case, we would like to see the candle close outside the fair value gap, but as long as the price is respecting the consequent encroachment, we can be pretty flexible with the price closing just below the consequent encroachment. Sometimes the price can also reach up to fill the fair value gap, and in such cases, it is preferable to see the price closing outside the consequent encroachment of this fair value gap. The most important thing to look for when invalidating a fair value gap is where the price closes. So when the price starts to close over the consequent encroachment or outside of the fair value gap, it is an indication that the price is not respecting the fair value gap, and most of the time, price will not reverse back down and the SIBI is deemed invalid. Now let's look at a few examples to understand this concept better. So we have a SIBI right here. Let's mark out the consequent encroachment using Fibonacci tool and see what happens. So you can see when price reaches up into this fair value gap, does not close over the consequent encroachment, or in other words, price respect the fair value gap and it is still valid for a reversal to happen. Now let's take a look at another SIBI right here. Let's mark out the consequent encroachment. You can see that the price did not respect the SIBI at all and closed right through it. This is when we will invalidate a fair value gap because the price is not respecting it. Now, if you look at a BISI or a bullish fair value gap right here and mark out the consequent encroachment to see what happens. The price reaches into the fair value gap and closes out. So it is currently respecting the BISI and it is still deemed valid. Another case is when the price breaks out and closes below the BISI, and in that case we can confirm that the price is not respecting the BISI and it can be regarded as invalid. The next thing we are going to look at is fair value gap inversion. To explain this in simple terms, inversion happens when a fair value gap fails or when the price closes through it, and then this fair value gap can be used as a support or resistance for future price movements. What this means is that I would expect price to return back to this old SIBI to use it as support and move away. Similarly, price could return back to an old BISI to use it as a resistance and then move lower. Another thing to note is that this does not have to happen back to back, meaning that this can occur later on after a period of consolidation. Let's look at some example to clear things up. So we have a SIBI right here and the price closes through it. So it is considered invalid. But that does not make it useless. We can then look to see if the SIBI supports the price. And we can clearly see that this old SIBI acted as a support for prices before getting a move higher. Here's an example of what I mean when I say that the fair value gap inversion does not need to occur back to back. So we have considered another BISI, and right here we get a close below this fair value gap. So it is deemed invalid. Now let's see what happens when price returns to this old BISI. You can see that the price returns to this old BISI. It uses it as resistance to go lower. But this did not happen suddenly, and the price took a while to return back to this BISI. For our next example, we have a SIBI right here. So let's see how the price reacts to it. And you can see the price has filled this fair value gap, but the price closes out of it. So it is currently respecting this SIBI. But right after this, we can see that the price closes over this SIBI, invalidating it. Now let's see if an inversion happens when the price returns. And you can clearly see how the SIBI was used as support and the price returned. So I think that clears a lot of questions regarding imbalances or fair value gaps. You need to be aware that imbalances in chart create the fuel for the uptrending price movement. However, you should not mindlessly enter a trade in an imbalance zone. It is necessary that you use strong confluences, and it is also necessary to monitor the context and make decisions based on it. I hope you have found this video helpful, and if you did, please consider liking and sharing this video. And make sure to subscribe to the channel and also enable the bell notification so that you will never miss any upcoming episodes. I will meet you guys in the next video. Till then,